Welcome to the CFP Study Hall, where each episode we break down 3 CFP exam style questions to help you pass the CFP exam. I'm your host, Nicole, and each episode we start with an easier question, move on to something a little bit more challenging, and then we finish with a tougher scenario that requires you to think more like a financial planner. So grab your notes, open your books, and let's get to work. Question 1. According to the CFP Board's financial planning practice standards, the first step in the financial planning process is to A. Develop financial planning recommendations based on the client's stated goals. B. Understand the client's personal and financial circumstances. C. Implement the financial planning recommendations the client has approved. D. Present alternatives and obtain the client's decision to proceed. Now take a moment and see if you can work through the answer. All right, let's break it down. First, let's eliminate the incorrect answers. Choice A is incorrect because developing financial planning recommendations happens much later in the process. A planner cannot build meaningful recommendations until they fully understand the client situation. Now, choice C is incorrect because implementation comes after recommendations have been presented and the client has approved them. Choice D is also incorrect. Presenting alternatives and obtaining the client's decision happens after analysis and the recommendations development. So that leaves us with our correct answer, choice B. Understand the client's personal and financial circumstances. The CFP Board's financial planning process begins with understanding the client's personal and financial circumstances. This involves gathering information about the client's values, their goals, their financial situation, and other factors that are really going to shape the planning engagement. Only after thoroughly understanding the client's circumstances can a CFP professional provide meaningful financial planning guidance. Now let's look at question 2. A client earns $95,000 per year. They spend $78,000 on living expenses and taxes, and they contribute $12,000 per year to a 401k. The remaining $5,000 covers miscellaneous expenses. What is the client's savings rate? Now, in case you might be driving or not have a pen and paper handy, I'm going to go ahead and explain the math with each answer. So hopefully that allows you to pick a correct answer without needing to pick up a pencil. So what is the client's savings rate? A, 8.2%, 78,000 saved relative to 95,000 in income. B, 12.6%, 12,000 saved relative to $95,000 of income. C, 5.3%, 5,000 remaining relative to $95,000 income. Or D, 17.9%, $17,000 combined relative to $95,000 of income. Take a moment, see if you can work through the answer. All right, well, let's work through the math. The savings rate measures how much of a person's income is intentionally being saved. Formula is very simple. Savings divided by gross income. In this scenario, the client's contributing $12,000 per year to their 401k. That amount is clearly being saved. Their income is $95,000. So the calculation is as simple as this. $12,000 divided by $95,000. When you do that calculation, you're going to get approximately 12.6%. So our correct answer is choice B. Now, this ratio helps track wealth building progress relative to income and is a really important metric when evaluating retirement readiness. It's also worth noting that the additional $5,000 of remaining funds could increase the client's savings rate if it were redirected towards savings or investment portfolio. Now let's look at question 3. A parent in the 37% ordinary income and 20% long-term capital gains bracket owns stock worth $50,000 with a $10,000 cost basis. Her adult child is in the 12% ordinary income and 0% long-term capital gains bracket. Which strategy is most tax effective for transferring the stock's gain to a lower tax environment? A, gift the stock to the child, who sells at 0%, saving $8,000. Sell first at 20%, pay $8,000 tax, then gift the $42,000 in cash. C. Gift the stock. The child pays at the donor's 20% rate due to carryover basis. D. Hold until death. The child inherits with a stepped-up basis, eliminating the gain. Now take a moment to see if you can figure out the answer. All right, let's break this one down. First, let's calculate the embedded gain. The stock is worth $50,000 and the parent's cost basis is $10,000, which means right now there's a $40,000 capital gain. If the parent sells the stock, that gain is going to be taxed at 20%, which results in $8,000 in tax. Now let's work through each of the answer choices. Choice B is incorrect because if they sell the stock immediately, that's going to trigger that $8,000 tax bill, which really defeats the purpose of shifting that gain to a lower tax bracket. Choice C is incorrect. When appreciated property is gifted, the recipient receives a carryover basis, meaning the child keeps the parent's original $10,000 basis and holding period. However, the child will still pay tax at their own capital gains rate, not at the donor's. Choice D would eliminate the gain entirely through a step up in basis at death, but this strategy delays access to the funds and depends on ultimately uncertain timing. And that leaves us with the correct answer. Choice A, gift the stock to the child who sells at 0%. If the parent gifts the stock and the child sells it, the child keeps the $10,000 carryover basis, which means the $40,000 gain still exists. However, because the child is in the 0% long-term gains bracket, the tax that is owed on that $40,000 gain is zero. Compared to the parent selling the stock and getting that $8,000 tax bill, this strategy is going to ultimately save the family $8,000. One important caveat that planners should remember is the kiddie tax. So if the child is under age 24, a full-time student, is still considered a dependent, then that tax benefit ultimately can be eliminated. But assuming the child is an independent adult, gifting appreciated assets can be a very effective income shifting strategy. And that wraps up episode 3 of the CFP Study Hall. Today, we covered questions focusing on general principles of financial planning, including the financial planning process, savings rate calculations, and income shifting strategies. Until next time, keep studying and remember, this is a marathon, not a sprint.